All right, hello economics students. If you're still listening, you're not going to make any silly mistakes on your exam. Good on you. We're looking at Unit 4, Outcome 1, and Monetary and Budgetary Policy, which are, of course, our aggregate demand policies. A couple of you have come to me and asked about some of the past VCAR questions, which say using aggregate demand policies. And you've asked what now seems like a silly question. What are our aggregate demand policies? Well, they are monetary and budgetary. Okay, and of course, budgetary has aggregate supply impacts as well, but monetary and budgetary are our aggregate demand policies. What's difficult about this area of study? Well, debt and deficits, we're going to do now, automatic stabilizers, the charter of the RBA, and I think the most difficult, which is how to evaluate monetary and budgetary policy. Okay, so let's first start out by thinking about the difference between debt and deficit. Two very different concepts, but it's important to understand their relationship. So the debt is what you owe. Okay, you borrow $100 from somebody, you owe them $100. You borrow $50, another $50, you owe them $150. If you then pay back $100, you still owe them $50. My point is that debt can accumulate or decrease over time. A deficit's different. A deficit is a snapshot over a certain period of time, looking at the transactions. Okay, in this case, in the case of the budget, we're looking at the difference between outlays or expenditure or expenses and revenues, which is primarily tax revenue. And we're looking at over the financial year. So from June to July, okay, one whole year. What we're looking at is the relationship, or what's confusing, I think, is the relationship between the two. So we should all know the difference between a debt and a deficit, or even you could say debt and budget outcome, but we perhaps get confused about the relationship. So let's clarify that now. Here we're looking at a trend in the budget outcome over time. It's below zero, it's a negative number, so we know that's a deficit. That means that the government has outlays or expenses greater than its revenues. And we can see that the outcome is getting smaller, or I should say the deficit is getting smaller over time. And what's confusing sometimes is the examiner will ask you, well, what's the likely impact of this trend in the budget outcome or this decrease in deficits on Australian government debt or public debt, same thing. And students will say, well, you know what? The deficit's getting smaller, so that must mean the debt is getting smaller. No. You will not make that mistake, because debt is still increasing, just by a smaller rate. So of course we know that every time we run a budget deficit, that must be funded via borrowing or by debt. So every time there's a line below the zero, every time there's a deficit, debt increases. So let's look at some numbers just to back this up if you don't believe me. So a budget outcome is in 2019 was a deficit of $100 billion. We have to add $100 billion of debt. In 2020, it was $90 billion, so it's getting smaller, but we still have to add $90 billion in debt, and so on. You can see the deficit is getting smaller and the debt is increasing just by less. A bit of an extension to this is that remember that when you borrow money, if you or I were to borrow money, we would have to pay interest on that borrowing. It's a fee for borrowing. It's the same for the Australian government. When they borrow money, they have to pay interest. And we actually can see that when we pay interest, when the Australian government pays interest, I should say, that's an expense to them. So that adds to the size of their budget deficit in the future, all things being equal. So let's look at an example. If you run a deficit of $100 billion, we have to add $100 billion to public debt because we have to go out and borrow, sell bonds if we're the Australian government. Then we have these interest repayments on the debt, the fee for borrowing. Let's call them $3 billion. It's a little bit less, but let's call it $3 billion. Well, that's going to be an expense in a future budget, or it could be current, depending on the accounting. But in a future budget, let's assume, we'd have to add $3 billion of expenses, which would increase the size of the deficit, which would then increase the size of the debt, which would then increase interest repayments. So it can, and it does, have the tendency to spiral, which is why it's so important for the government to return the budget back to surplus in the medium term. That sort of inbuilt goal that the budget has. And also for the government, to maintain their AAA credit rating, because that determines the fee for borrowing or the interest rate on their debt. So just to refresh and clarify the relationship, whenever we have a deficit, we must increase debt. Doesn't matter the size of the deficit. Even if it's a $1 deficit, debt still increases. And anytime the government runs a surplus, it may decrease its debt. We also said that an increase in debt may lead to an increased deficit in the future. Okay, so let's explain the relationship between the budget outcome and the level of government debt. This is a past exam question. I can't remember, maybe 1 or 2 years ago. And because it's worth 4 marks and it's a relationship question, we've got a bit to do here. But our key terms are the budget outcome, or the things we're supposed to be showing the relationship between, is the budget outcome and the level of government debt. So if I was marking this, you'd need to demonstrate an understanding of the level of government debt or public debt and what a budget outcome means. So the first 2 marks are essentially to define your key terms. Then you have to show the relationship, which is basically what we just did. A deficit leads to an increase in debt, and a surplus allows the government to decrease debt. Automatic stabilizers, and I put S there because it is plural. Usually VCAR asks you for 2 automatic stabilizers, and there are in fact 2 automatic stabilizers. What they do is smooth out the business cycle. They work without government intervention. Whenever you talk about automatic stabilizers, put that in brackets, write about that, just add extra knowledge to your answer. But essentially what they do is cool a hot economy. So if the economy is running too hot and growing at too fast a rate, it can actually slow that down. And if there's a slow economy that's not growing by enough or actually decreasing, it can stimulate a slowing or contracting economy. So it will offset the drop in aggregate demand in that case, or buffers the drop in aggregate demand. I think what we get confused with is we will say it increases, it will stimulate growth. Well, it'll sort of offset a drop. It'll slow the rate of growth. So automatic stabilizers, remember there are 2 on the revenue side of the budget, or taxes, and we have a progressive tax system in Australia. We'll come back to that. Or on the expenses side, on the outlay side, which is via welfare payments. Let's look at how they'd work in a downturn, just as a little refresher. So in a downturn, as workers work less hours and there's less jobs around, so higher unemployment, they're likely to pay less tax. So they do move down the tax bracket, given our progressive tax system. So therefore, the government will receive less revenues. And on the outlay side, more people will qualify for job seeker payments or welfare, what we used to call New Start, because they're unemployed. Okay, so automatically the government will spend more on outlays as more people qualify for that. And what that does is sort of offset or slow the drop in disposable incomes. What some of you are doing, some of the work I'm reading from you is saying that disposable incomes will increase. It's party time, Mr. Verlin. No, it's not, because they've still lost their job or they're now on job seeker payments. They'd much prefer to be in a booming economy. What it does is slow the drop in disposable income and therefore slow the drop in AD. Okay, so wages, remember disposable income is wages minus tax plus transfers. So if your wages are gone altogether, you're going to get transfer payments or job seeker. That's lower than your wage. And if your hours worked drops, you're going to get a lower wage and you're going to pay a little bit less tax, but your wage is still going to be lower than it would have been, or your disposable income. Okay, so just be clear about how those work. The role of the RBA, I think this is really simple, but for some reason students just ignore it on the question when it says explain how transmission mechanisms work with reference to the role or the charter of the RBA. And then so students will go and write about the transmission mechanisms and completely forget the role of the RBA for some weird reason, because it's very simple. So I think it's just one of those things that the examiner just tacks on, or the exam writer just tacks on to a question, adds a mark, and for some reason we don't get it. So let's be really clear. The charter sets out the reason why the RBA exists. It's the government's written this charter and said, hey, we need an RBA, that your job is this. And you know their job. It's to ensure low inflation, to ensure prices rise on average or sustainably between 2 to 3% each year. Okay, I would say just write about this whenever you talk about the RBA. So if you get a question about the RBA, just write about their charter. Why not? It couldn't hurt. Finally, to evaluate. So remember, 99% of the, let's not put percentages on it. Evaluate usually is about strengths and weaknesses. Certainly when we're referring to policies, evaluate asks us to weigh up the strength of the policy versus the weakness of the policy. Okay, and it's the same for aggregate demand or aggregate supply. Sometimes you get asked to evaluate the market, still doing strengths and weaknesses. Sometimes you get asked to evaluate trade liberalization, similar strengths and weaknesses, but it's probably more short-term, long-term, okay? And these are some past exam questions that VCAR's asked about this concept. And I've actually been a bit misleading here, because usually they tell you one strength, one weakness. So I've been a bit harsh when I've just said evaluate the use of this, but Usually they say evaluate, and then they tell you what they mean by evaluate. So it could be written as any one of these questions or any one of these sort of setups here. The way you approach it is exactly the same. You're going to do exactly the same thing. But for argument's sake, I'm just going to use evaluate the use of in achieving. So we could say outline one strength and one weakness. It doesn't matter. But here's another sort of structure for a question which unlocks a whole range of combinations. So if you can work out the structure for this, you could answer any one of these combinations that you may get. And as I said, it's the same for aggregate demand and aggregate supply. So evaluate the use of X policy. Well, it could be any policy we've looked at all year. I've got them all here. I know we're doing aggregate demand for now, but we'll do aggregate supply in a second. And it will always say in doing something. So what's the strength of it in doing something? Usually in achieving one of our goals. But sometimes it's in improving living standards. What's the strength of it in terms of its ability to improve living standards or economic activity or jobs and growth? Or if it's an aggregate supply policy, it might be in increasing aggregate supply, okay? So that's important just to understand what Y is and how the strengths and weaknesses help or hinder the ability to do Y. Okay, so let's go back to, let's do an aggregate supply policy. That should have been aggregate demand, but that doesn't matter. It's going to be the same. So how do we approach a 4-mark question? And usually it's 4 marks for an evaluate question. Okay, if it's an 8-mark, you've got to usually evaluate 2 policies, 4 and 4. If it's a 6-mark question, well, they want something extra, don't they? And usually that's some sort of contemporary flavor. So evaluate them over the last 2 years. And therefore you've got to get that extra mark. You've got to put in something that happened over the past 2 years, an example, but also a reference to whether or not full employment has been achieved or not. Okay, so just keep an eye out for that, but usually it's 4 marks. What do? We outline the strength of the policy. Then we need to outline how that strength helps achieve the goal or helps us do Y, whatever's in the question. So you need to make a very sort of stepped out link to Y, or in this case, full employment. So don't just say the strength of budgetary policy is it does this, which helps achieve full employment. That's not enough. You need to step it out. So it may be that it targets specific areas of weakness. Maybe businesses over, the COVID pandemic. Therefore, the government could cut taxes via the instant asset write-off, stimulate investment spending, stimulate growth in the economy, create some derived demand for labour, and so on. Okay, so you need to make a little bit of a stepped argument here for your 2nd mark. Then you're going to say, however, one of the weaknesses is that it's politically constrained. So they're subject to political bias, and maybe some of the policies that were best suited for the economy, that would have stimulated the economy, weren't passed because they were politically unpopular, okay? And therefore that hinders or makes it harder to achieve Y, or in this case, full employment, okay? And again, you need to step it out. Hopefully that helps. Finally, we're going to do aggregate supply. So remember, know your policies and know how they work. Each of them has a little a little sort of difference in how it works, but it's a fairly standard argument about how they work. So I would say know a contemporary example of each, just because that's going to build your answer. That's going to bulk up your answer if you can give a contemporary example. Remember that they're all designed to do the same thing. So they're all designed to increase aggregate supply. They're all designed to increase productive efficiency and increase aggregate supply. But it's also key to know the relationship between the two, as I just remember what this slide's about. Remember the relationship between aggregate supply and efficiency. Some of us have been having trouble with this question. So an increase in aggregate supply. First of all, remember aggregate supply is not the ability and willingness to produce. That's the aggregate supply curve. Aggregate supply is the total output in the economy, okay? So if we want to make a link between the two concepts, if we can increase aggregate supply by increasing the productive capacity, that's also an improvement in productive efficiency. That's the first one, okay? So maybe we increase aggregate supply by improving productivity, and therefore that improves productive efficiency. But you can also, an increase in productive efficiency, we could say, would lead to an increase in the total output of the economy. So if you improve productive efficiency. Also remember your 4 types of productive efficiency there. This is how questions usually get asked about aggregate supply policy. We've been through them before, so I'm going to leave them. There's a good structure for you. Remember, strengths and weaknesses. For some reason in aggregate supply, and I know we just did that aggregate supply policy, students always write about how they work rather than what the strength is. Know the strengths of aggregate supply, okay? For example, one strength of immigration policies can be turned on and off quickly. or you just use your budgetary policy ones that it can target specific areas. But please make sure you write strengths and weaknesses, not how they work, not that they increase productive capacity. All right, that's it for the content. Hopefully that helped, and hopefully you're not going to make those silly mistakes that I went through. I think we'll do charts and graphs in the next video. Bye for now.